Hello and welcome to Spy Trader, the podcast that breaks down the S&P 500's latest happenings for you. I'm your host, Chuck Cashflow. It's 6 p.m. on July 31st, 2024, and we've got plenty of market-moving news to unpack. Let's dive in. Today, we'll be talking about the forecasted shift toward dividend stocks and what it means for the S&P 500. There's a buzz in the market about trillions of dollars potentially moving from U.S. money market funds to dividend-paying stocks. Why? Well, the Federal Reserve is expected to cut interest rates, possibly as soon as September. $6 trillion currently sitting in U.S. money market funds is expected to flood into the stock market, specifically targeting those juicy dividend payers. According to Bank of America, more than 200 stocks within the S&P 500 have a higher real return potential than the 2% offered by 10-year Treasury yields. Astonishingly, around 75% of these stocks are underowned by professional investors. That's like finding a gold mine in your backyard and not picking up the shovel. Speaking of dividends, analysts have highlighted companies like AbbVie, Chevron, Gilead Sciences, and Duke Energy as prime targets due to their high yields. These stocks are not just good for a steady income, they also provide stability in tumultuous times. Now, you might be wondering, why the sudden love for dividend stocks? For one, it's the expected drop in interest rates. Lower rates mean your average fixed income instruments just won't cut it anymore for those yield-hungry investors. Hence, stocks dishing out hefty dividends become the belle of the ball. But what does all this mean for you? First, keep a close eye on the Fed's actions. If they hint at or proceed with rate cuts, it's like they're setting the stage for a party, and dividend stocks are the VIP guests. This potential influx of funds could catapult those high-yield stocks and make them even more attractive. Second, consider equity rotation. Historically, when rates drop, we see a major rotation into dividends. If you're not already positioned here, it might be time to give it some serious thought. Here are a couple of trading recommendations. 1. AbbVie, ABBV. AbbVie is a pharmaceutical gem. Known for its strong dividend yield, this company not only provides a steady income, but also has a robust pipeline of products that can ensure growth. With interest rates on the verge of dropping, AbbVie's dividends become even more appealing. 2. Chevron, CVX. Amidst the fluctuating energy markets, Chevron stands out due to its strong dividend history and solid balance sheet. While energy prices have their cycles, Chevron's dividend payout has been impressively consistent, making it a reliable pick. And hey, if you're into heavy music, I've got a joke for you. What's a short seller's favorite type of music? Heavy metal, because it always goes down. In conclusion, the anticipated shift towards dividend-paying stocks could herald a new investment era, particularly if the Fed practices what it preaches on rate cuts. Stay vigilant, keep an eye on those monetary policies, and position yourselves smartly in those underowned but high-potential dividend stocks. That's a wrap for this hour's Spy Trader. Until next time, stay savvy and keep trading smarter, not harder. I'm Chuck Cashflow, signing off.